Firstly, I'd like to just welcome everyone here. Thank you so much for giving up your time to attend today's session. I hope you'll be able to stay for a few drinks and snacks after the presentation. It's also a great privilege and honor to welcome Stephen Cranston from the Business Day and Financial Mail. I'm sure you'll all join me in congratulating Stephen because he's just won the Telkom Business Journalist of the Year. Congratulations. I know today is a Jewish fast, so I should really say Mazel Tov. Today's been quite difficult to arrange because we've had to fit in with speakers and availability, and unfortunately today was or is Yom Kippur, and so our Jewish friends could not be with us today. We had one or two cancellations, but it's our intention to run sessions for trustees and for our clients on a regular basis. And our next session, which we're hoping to have next month, around about the 15th, 16th of October, will deal with the debt counseling industry. And that should be a very interesting topic because so many of our members are really under huge stress with the debt that they have. Debt counseling industry has been recently established. They're doing a lot of work, and we're partnering them with some of their efforts in providing quality advice and service to people who are financially stressed. Today's topic is equally important: socially responsible investment. What is this all about? Is it simply handouts to the poor? Absolutely not at all. In fact, SRI done correctly will help us all to achieve long-term investment goals. SRI is more about proper stewardship of scarce capital, holding management of companies to account in businesses in which we invest, in the infrastructural development of our country. Things are moving at a rapid pace in the retirement fund industry. Roughly 3 years ago, we hosted a breakfast on this very topic, where we were able to get the PIC, John Oliphant, and others to chat about SRI. At that stage, it was a new concept, and investors, investment managers, were slowly signing up to the SRI concept. Okay, charter. It's a worldwide thing. It's not a South African thing. But at the beginning of this year, Treasury launched a discussion paper which was called A Safer Financial Sector to Serve South Africa Better. This document acknowledged that increasingly important role of retirement funds and went on to state, pension funds play an important role in the national economy. Given South Africa's low savings rate and the presence of the twin fiscal and current account deficits, pensions are even more important for economic development. Pension funds smartly invested provide a mechanism for unlocking savings, stimulating economic growth, and ensuring that pensioners are provided for at retirement. A couple of days ago, on the 21st of September, Treasury posted 2 further documents for discussion, and I have them here with me today. And it's quite clear that government are now moving at a rapid rate to change retirement fund industry in this country. What is heartening is that from Treasury's side, it seems like they are wanting to work with the industry to encourage the industry to reform itself. And it seems like the industry is likely to be given somewhere around 3 to 5 years maximum to do just that. In the second and third papers published, they deal with compulsory preservation and how they're going to introduce that, compulsory retirement fund membership for all employees in the formal sector. And if you read that, there are a number of informal employers who do not have retirement funds, and they're going to be forced into doing something shortly. And then there's the focus on cost reduction of annuity purchases after retirement. And I'm pleased to announce that when we went away with our team and with our actuarial component, not last week, the week before last, we worked out that we could actually provide annuities from within the retirement space without any extra effort. And that's great for the investment managers because the money stays in the fund and simply the fund pays out annuities to the member from within the fund. No problem with moving capital from one institution, cashing it in, timing issues and getting it invested in another institution. So we are busy revising our rules, and we will speak to the trustees on that basis going forward. And I think it's a very exciting development. What is also interesting is that Treasury bring up the fact that if you have retirement annuities or annuities paid out of the retirement fund, and provident funds will no longer be able to pay cash on a phased-in approach, those will also have to pay out in the form of annuities. It means that a longer-term time horizon can be applied to the investment time horizon of each fund. And where they're going with that is that they're saying that they would like to see the costs of investments driven down and perhaps a far more paternalistic approach to investments. They acknowledge the heuristic behavior or the investor behavior of people doing silly things with their money over time. And we certainly as Tennant have been a proponent of not having individual investment choice and also not having life staging. And it has now come full circle, and we've been found to be absolutely correct on both those accounts. 2 or so months ago, we were very privileged to have Standard Bank present to us, and I invited a number of leading investment managers to a lunch in Sandton, where Standard Bank presented on the new ways of producing electricity, in South Africa and what the effect will be on this country. Joe, thank you very much again for coming, and I appreciate you, and Wayne, if you can just share with us your ideas on this new venture that Standard Bank has. Thank you.
Steve, thanks very much once again. This is the third time that Tennant have kindly invited us just to chat to a variety of audiences. I've tried to keep I've only been given 10 minutes, so what I'd like to do is just to keep it quite chatty. If there are any questions, I'll be happily answer them. And if there are any questions afterwards, please get hold of Joe or myself, and we'd be very pleased to answer any questions you have. Following the session, I think there's going to be a whole definition of what ESG is, and it'll contextualize everything that we've done here. From our perspective, why are we quite involved in this sector? So, first of all, what is it? This is the renewable initiative by the government to start providing an alternative energy source to assist us in growing the economy over time. And we have to diversify our different types of energy sources like wind, like solar. And we've also got a lot of coal. Recently, shale has probably got the green light, etc. We're still looking at nuclear. What's important here is that we probably need to roll out about 18,000 gigawatts of energy, 18 gigawatts of energy over the next 15 years or so in the form of solar energy. But what does this mean? In essence, what are the asset classes and what are we trying to do? South Africa's got excellent resources just in terms of provision of alternative sources. Solar energy, we've probably got one of the best resources in the world. There's lots of sun all the time. There's very little dust. And if you put the stuff in the Northern Cape, it can produce energy. The other element that we probably got as well in South Africa, especially along the coastal areas, is a lot of wind power. So if you go down to the Eastern Cape at any time, the wind always blows. With the Windy City in Port Elizabeth, etc., that whole area has got a lot of resources, and also in the Western Cape and on the West Coast. So South Africa is blessed with these resources. We don't have stuff like other green things like hydroelectric, etc. So we've got to make do with what we've got. So what does this mean? Well, for us to get out 18 gigawatts of power, let's say over the next 10 to 20 years, it's going to require approximately, we estimate, something between 250 to 350 billion rands worth of debt. This is an enormous amount of money. If you just have to contextualize it against where the bond market is and what their market capitalization is there, we are currently at about 1.3 trillion. So this could be as big as about 25% of the existing market that we have at the moment. Obviously, this will grow over time. It also depends where currencies are, etc. But this is just an estimate. This is a big number, and this is a big infrastructure spend that the country has. So how do we respond as banks? Well, there are two or three things that we have a look at. We understand that energy is required in this economy for everything to grow and everything to be hunky-dory. So we are so invested in the economy itself that we need to participate and we need to be able to facilitate these types of investments. So there's that element over there. We also know that this is an incredible amount of money that needs to be found, and we need to convince investors over time. This problem is far, far too big than one bank. This is an industry challenge. So I think that also contextualizes. And the other thing is that infrastructure is going to be the theme for development in South Africa and in Africa in particular over the next 10 to 20 years as well. So for us, it's a very much on-strategy type of project that we're trying to get involved in, but we need money from other people. What are banks going to be doing? Banks are going to be taking these investments, making sure that we can get them up and running, doing the cash flows of the timing of when the equipment needs to come, make sure they get the FX. We try to take as much risk away from it as possible. Manage all those risks, eventually get it to a form during this construction period, usually the riskiest period. The construction period is probably between 18 months and 2.5 years, depending on what type of project. Photovoltaic, it's very simple. You just pop in modules and you get it up to the grid, and it's quite easy. You've all seen those windmills. They're quite big, so there's a little bit more logistics involved there, trying to get them to the center. So we've got to make sure that all runs smoothly. And in particular, when you're starting an industry, you also got to make sure that you've got everything runs quite smoothly. So that's our job over there. Once you get through the construction period, you are then going to have this, everything's hopefully the wind is blowing and the sun is shining and your equipment's working. And then you're going to, as long as that happens and your equipment's working correctly, you are then going to receive a tariff from government for every sort of megawatt that you produce. So if you have your plant up to spec, you are going to get this quasi-government payment that's coming through. So what does this mean for the industry itself? I think that this is probably one of the key examples of I know socially responsible investment is a bit of a swear word, but this is green power. This is trying to mobilize something that is needed in South Africa for GDP growth, and we need to try access the capital that's around there. So it's something that we are definitely want to get involved in, and we need to try get that money. So what do we have to do? Unfortunately, a lot of these transactions are quite small. Well, not small. I mean, they're still between 1.5 to 2 billion per project. But what does that mean for us is that we can't really go directly to the capital markets because we can't issue bonds. There's a little bit of strangeness. So we're going to be, hopefully over the period of time, over the next 3 years or so, we're going to be starting to collect a lot of these projects and start getting a portfolio of these green projects, putting them into a securitization vehicle that is hopefully going to be diversified just in terms of geography. It's going to be diversified in terms of each different project, so different developers, different types of wind, solar, different areas. So hopefully this is going to be a nice diversified approach. We might even have to start going to other banks because if there's not enough diversification, cooperate with them to put these projects together so we can get it through to the asset managers in an investable form. So the likely plan, and we still haven't drawn down on the first deal that we're trying to do yet. That's probably going to come by the end of October. But hopefully over the next 2 years, we're going to be able to collect all these assets, put them in a securitization vehicle, and be able to sell off the paper through to asset managers who can invest in it. We are very conscious that mandates probably have to change over time. As the environment changes, I think trustees are going to be asked to start looking at alternative investment sources. The ESG space is going to be an incredibly important part for us to start getting that social responsibility into our investment criteria. So by being able to provide these products to investors who want to participate in these types of projects and also contribute to the GDP growth of the country, we are hopefully going to be able to provide these instruments that will provide a very good risk-adjusted return for the investors as well. So that's sort of the plan where we have. I'll be very free. It's a very high-level thing. I don't have much time here, but if there are any questions, just you want to guide what I can deal with some of the questions. Just to give you an idea of the number of deals, bid date 1 is only about 20% of the total amount, so that's 3,625 megawatts that's going to be available. Bid date 1, there were 28 projects. Bid date 2, which has been awarded, but we still haven't drawn down, there's about 18 projects, and so we anticipate the phase 1 of this is probably going to have about 50 projects in total that are going to be dotted all over the world. All over the country, mainly in sort of the Northern Cape for solar, and then you're going to have a lot of wind around the area. So you're going to see a lot of these things that are going to be coming up and coming onto stream. Our difficulty that we're probably facing at the moment is it's taken, I think government, and we did probably as well, we anticipated things happened a little bit quicker. I think we needed a little bit more time to make sure that everything's in place. But with time, also, then things change. The shale investment. So this is going to change the full number we anticipate over time. The 18 gigawatts might be scaled back, might be spread around a little bit more. But as time goes by, I think this. I mean, just watch this space. There's very little that we can actively give to the asset managers at this stage, because it probably doesn't suit their mandates, just in terms of the credit quality, because it's a risky phase that we have to get through construction. But as soon as we start diversifying and everything, we're hoping to get these instruments up to investment grade, which will then naturally form into the investment mandates that investors will have. A very high level, yes, please.
Is there already a local factory that makes these windmills? Is a huge thing.
I think that they've been quite clever, just in terms of government, what they've been trying to do. They're trying to, as you go through each of the bid phases, the first bid phase, there's certainly a local content amount. There's a lot of labour. There are quite a few social criteria. You have to have BE, etc. So I think it sort of covers most of those sort of social responsibility sides. But what's also becoming quite interesting, as the bid phases progress, the tariffs are coming down that the guys are bidding at. So there's additional competition is coming in. So it's going to cost the taxpayer less, because these are subsidies. But what they're also trying to inject is to use it as economic stimulus. So they're starting to build assembly plants in Cape Town for the production of PBE things. They're going to start looking at the fiberglass blades for something. At the moment, most of it has to be imported, but there is over a period of time, a lot of that manufacture will come naturally to South Africa. So they'll be paying local people, just in terms of the tariff, which I think is also important.
And just on the pricing in terms of the power supply to the grid, is that been formalised and agreed, and is that clear? Because I know that was an issue for the viability of a lot of these projects.
Just to give you an indication of pricing, just in terms of what the tariffs are, I think the Eskom, when I did this little slide, was probably putting electricity into the grid at about a cost of 60 cents per megawatt or so. Okay, so that's their number. Just in terms of wind, the tariff for bid date 1, the people who won what was the average tariff? It was R1.14, and for photovoltaic it was R2.75. In bid date 2, the photovoltaic went from R2.75 to the average bid rate of R1.65. That's a 40% reduction, just in terms of. So competition is definitely playing its part to reduce these costs. And we all know that the Eskom is going to be increasing tariffs, probably much higher than inflation. So we anticipate the parity between what the subsidized rates and what Eskom is actually charging is probably for wind, because it went from R1.14 to 89 cents. So we anticipate probably in the next 2 to 3 years that there will be grid parity, particularly for wind. It depends on what projections you make for Eskom. That's the key thing. But if they're at about 15 to 20%, we should hit parity as well. And then on the photovoltaic side, we also anticipate technology improvements. So that should also bring the cost down.
Is it anywhere linked to oil or any of the other energy costs?
No, they're linked to inflation. So most of them are. There's either partial or full indexation that the guy. So it's almost you're getting a diversification of supply and diversification of pricing, to be quite honest. And what's also very good about these particular projects, there's a huge capital expense up front, and that's where all the risk is, trying to get it constructed, etc. But after that, your maintenance costs are very low. For modules, you just have to keep them clean and make sure all the plugs are working. And for wind, you probably got to replace a the, what do you call those? Gearbox. A gearbox probably every 45 years depending on the model. So the maintenance costs, it's quite sustainable, and eventually you are going to get the tariff going, and these things will be lower than the tariff for, yeah. They are. Yes, there is at the moment what the NERSA is trying to do is put up a single buyer's office, which is independent of Eskom, as Eskom tries to break itself from generation to power to transmission. So they are trying to encourage independent power production going forward. So that's why they're setting up the central buyer's office, which hasn't been legislated quite yet, but it's well into the process. It's obviously much better from a credit perspective. Yes, and yeah, exactly, and you can understand Eskom's reluctance because they want elements, they want scale, they want the ownership, and to break transmission lines with generation for them is probably quite a struggle at this stage. So I think there are quite a few hurdles that they have to go through, but also bearing in mind all these payments, although it'll be paid by the single buyer's office through NERSA, etc., will be government guaranteed. So if you produce and you got your contract, you're fine. The construction period is about 2 years, so there'll be no production then. And then there's a contract for the following 15 years for that thing, with a 5-year tail at the end for the equity providers. They can start gearing up a little bit later. So there is government guarantee if you produce. So that is a necessity for us to be able to bank them. So, we're not going to invest our money. We've got about a 9 billion exposure unless we're very sure that we're going to get our money back. We are banks. That's what we do. Okay, so it's one of the asset classes that are coming, and I think it's probably going to be one of the, certainly one of the most exciting. We just don't know when it's all finally going to happen. But then I'll hand over to Ian. Thank you.
Thank you, Wayne.
Thank you for your time.
Right, our main speaker this afternoon is Professor Evan Gilbert. Following the completion of his PhD, Evan worked for a major international strategy consultancy, the Monitor Group, followed by an 8-year period in the world of academia at UCT and Stellenbosch. Evan recently left Cadiz Asset Management after 18 months as their research analyst for the asset management company, and has been appointed as head of institutional asset consulting at Mitton Optimal Asset Management. His specialities include capital budgeting theory and practice, real options analysis, investment behavioral finance, equity and bond market investment strategies, and portfolio optimization. Evan, thank you very much for coming to us.
Last week, Barclays Bank was fined $450 million by UK and US regulators. It's the first bank to be fined after admitting it submitted inaccurate interest rates.
When I read the emails from those traders, I got physically ill. It's reprehensible behavior, and if you're asking me, should those actions be dealt with? Absolutely.
Export orders across China have declined due to the crisis in Europe and the US. And things are only expected to get worse. Recent job cuts have been the sharpest in more than 3 years. The government has been trying to ease the pressure through focusing investments and slashing interest rates. But growth in the world's fastest growing economy is expected to be lower this year than the 10% average it has seen every year of the last 2 decades.
Petrol and diesel still aren't as expensive here as in many other countries, but the price has soared 25% in the past year.
Petrol will go up every single month, but our salaries stay the same.
The government says it can't control the international price of crude oil, so people will just have to learn to be fuel efficient.
This is bad news for Julius Malema, but he would have expected it. He would have known that the balance of power in the National Executive Committee of the ANC is firmly with President Jacob Zuma.
The reality is South Africa desperately needs jobs, but the power of the unions within the governing alliance means that jobs, even for unskilled workers, must meet basic minimum conditions, which many employers say they simply can't afford, so they lay staff off or shut up shop altogether.
Meanwhile, in Italy, the Moody's rating firm downgraded the country's bond rating by 2 notches. The news sparked anger on the streets in Rome.
So why are investors so eager to trade this company? Well, in less than a decade, over 800 million people have signed on, which means if Facebook were a country, only China and India would have more citizens.
Following grueling negotiations, the Spanish government returned home in June with a deal for 100 billion in European aid for the country's troubled banks. But this came at a cost. Presented as a victory by Madrid, the aid was conditional on a further round of austerity measures, with a 65 billion package of tax rises and spending cuts triggering a wave of demonstrations across the country.
I think we're facing a historic task, she said. We're facing the historic task of saving the euro. The euro is good for us all. The euro is part of the economic success of Germany. Europe without the euro is unimaginable, and so it's worth taking any responsible effort to solve problems at the root.
Well, here is one thing politicians cannot debate. 40% of the jobless in the United States have been out of work for more than 2 years. Finding solid, long-term employment is in many respects a job in itself.
It's a rogue institution, according to New York's top bank regulator, accusing Standard Chartered of hiding $250 billion in illegal transactions tied to Iran over the past decade. The regulator says the secret transactions generated hundreds of millions of dollars in fees over nearly 10 years and could result in the bank losing its license in the state.
Some areas of China's capital saw 460 millimeters of rain in 14 hours. The result, the heaviest downpour in 61 years.
Right, well, I'd love to claim that that was my idea, but actually had nothing to do with me. Steve very kindly came up with that as a link between what we've been hearing from Standard Bank and what I'm going to talk to you about now. Let me just get this up and running. Steve, oh, sorry, Steve, we lost the presenter. Thanks. I'm not as confident as Wayne. I can't just talk off the cuff completely for at least 40 minutes or whatever I've been allocated. What Steve very kindly asked me to do is put together an investment solution to investors looking for socially responsible, ESG, environmental, society and government type investments. Now, what this did was really stimulate for me as an asset consultant to think about ways in which we can offer our clients solutions to deal with the kind of issues which the video highlights. Extreme weather, corporate governance failures, society going through changes, events, sometimes revolutionary type changes such as the Arab Spring. These are the facts of life today which we as long-term investors have to deal with, either directly on behalf of you trustees of your fund or us as advisors to trustees of funds. And as we'll see when we go through a little bit why you should consider these, from a regulatory perspective, you being put under pressure to do so as well. In terms of revised Regulation 28, PF 130 in terms of good governance for retirement funds, and these and a crease of the Code for Responsible Investing in South Africa, these are now an obligation for you as a retirement fund trustee, is to make sure that your investments are deal with these issues, the investment decisions that you make deal with these issues. So the question is, how can we as consultants help clients deal with environmental, social governance, socially responsible investing? And that's what I'd like to present today. I'm going to
just to give you a little bit of background about who we are, Miton Optimal is not a well-known brand. It's a small retail-focused business for doing fund-to-fund management, focusing on asset allocation. That's really what we do. Asset consulting is a division of that, and I'm responsible for asset consulting, and we provide investment advice to retirement funds. And we've got some offices around the world, but we're predominantly South African, and certainly from the asset consulting side, all our clients are South African. What we try and do is focus on risk management, particularly through asset consulting. And by doing a fund-of-fund type solutions, we allow to sort of pick the best managers available to us. And that's one of my jobs, is to do it. So what you're going to see now is really an application of that fund-of-fund type of solution, but with a specific ESG, SRI type focus. Okay, so first of all, there's a lot of jargon around this, which I kind of want to put... Well, just clarify a little bit, because when I first arrived at Cadiz Asset Management, I was asked to work with their SRI bond fund to help present and support the sales effort around the fundraising for this particular fund. And I really, to be honest, didn't know much about ESG at that particular point in time. So I took quite a while to kind of educate myself. And there are several versions and there are several flavors that I'd like to just to start with. ESG in particular stands for environmental impact, social impact, and corporate governance. That's where the ES and the G comes from. SRI that Steve was talking about is in a sense another version of this, focusing more on the social impact of the investing. But they are used interchangeably. And ESG is really focusing on sustainability, whether it be environmental, whether it be social, or the corporate governance, the oversight to make sure that the actions are sustainable. But it really is around long-term sustainability of business and investments. There are different versions of ethics-based negative screening type investments. Now, ESG is not that. The Sharia type funds where you're wanting to maintain a particular ethical system in terms of your investments. So, for example, no tobacco, no liquor, no interest-based companies. Those would, financial service companies, those would be your Sharia type funds. And that's a particular ethical approach to investing. Now, ESG is not that. What ESG really is trying to encourage sustainability by focusing on the environmental impact of companies' behaviors, the social impact of those behaviors, and the corporate governance mechanisms in place with companies to make sure that their actions are focused on the long-term sustainability of both their operations as well as the society and the environment in which they're operating. So ESG is very much about sustainability, about long-term results. And so what I've been tasked to do here is to identify investment opportunities which implement this long-term sustainable type of focus in their portfolio construction and management. Why should you worry about this? Well, as the video highlighted, there's some big challenges that we're going through at the moment. First of all, you can make an argument along the lines of it's the right thing to do. Without a sustainable course of action today, the future is not going to allow for any comfortable retirement, and ultimately that's what your fund's members are looking forward to. So you need an environment that's sustainable environment. You need a sustainable society that'll allow your members to have and ultimately enjoy their retirement. But it's also going to improve your investment returns. And some of the funds that we find here are actually accessing investment opportunities exactly of the kind that Wayne was talking about, which are new and which allow you to earn an enhanced return. And so people, I think, possibly for the wrong reasons, have always seen SRI as being a handout, as being a somehow less than good business. In fact, there are very strong arguments, and there are very clear examples of where an SRI type focus or an ESG focus can actually enhance the returns. And ultimately, in the long run, you need that sustainability to have returns in the first place. So it can enhance your investment returns. And but another argument completely unrelated to it is one that I've mentioned already, namely that you have to. Regulation 28 says that you have to take ESG considerations into account when you are making your investment decisions. It's part of your responsibility, your fiduciary responsibility as a trustee. And PF 130 highlights the corporate governance dimension of your role as a trustee, and you have to maintain good corporate governance in that sense. The Code for Responsible Investing in South Africa, CRISA, while it's a voluntary code, is one which if you do not adopt it, you need to explain why. So you don't have to follow it, but you do need to justify to your members and ultimately to your members why you're not applying this in terms of the management of your fund's assets. So there's some strong reasons to do it, both from a sort of a moral perspective, from a fiduciary perspective, as well as from a regulatory perspective. So ultimately, while we're offering you a very specialized solution here, it is a responsibility that's going to permeate ultimately all of your investment decision making. I've got a couple of slides here just focusing on a couple of environmental type of sustainability issues. I'm not an environmental scientist. This is really not my area of speciality, but these are very well known facts about or issues raising just raising awareness of environmental sustainability. I mean, the first problem is, of course, population growth. Now, population growth per se is a challenge, but it's also the rising income standards which leads to increased consumption, which is ultimately the challenge from an environmental sustainability perspective. You've probably heard the statement that if everybody in China wanted to consume resources on the level that American consumers do, you'd need 3 planets, not just one. Unfortunately, we only have one. So it's a question of how to match those demands or those expectations with the limited resources that we have available. Just to give you a sense of development over the past century, this is from a book called Something New Under the Sun, John McNeill, and he just highlights the growth in demand and the growth in economic activity and the impact in terms of the environment. Global population has gone up 4 times. The economy has gone up 14 times. That just highlights the consumption kind of effects. Production up 40 times. Energy use up 16 times. Carbon dioxide emissions up 17 times. Sulfur dioxide 13 times. Ocean fishing catches 35 times. This is coming from a finite resource. It's just not really sustainable unless, we have to do something different about the way that we're going forward. And ESG type investing really focuses on the activities of the underlying companies to align their behavior with the long-term sustainability of the environment, society, and ensuring governance as well. The blue whales, 0.25% compared to what they were in 1900. So this is really, if a definition of sustainability is a set of conditions and trends in a system that can continue indefinitely, this is not sustainable. So changes are going to come. This is a study of our sort of systematic ability, at least our systematic limits to growth. And the green area over here just highlights on each of these different 7 key dimensions what we can do to survive on our current planet. And the red areas show where we are today. This was done, a follow-up to the Limits to Growth, the 1970s study that was done by the Stockholm Environmental Institute. And it highlights 2 areas particularly where we are way beyond our sustainable limits. The one area is the biodiversity loss, and the second one is the nitrogen cycle. Now, the nitrogen cycle is the use of fertilizers and stimulating the production of nitrogen into the environment, which can lead to ocean depletion through declining oxygen levels. And you get these huge dead spots, or where the rivers, the offlow of the rivers into the seas create this, all through the use of nitrogen-based fertilizers to enhance crop production. You're getting these dead areas in terms of the ocean ecosystems. And so these are some of the areas, the challenges that we're facing at this point in time. So from an environmental perspective, we really are pushing up against the limits of our sustainable growth, and changes have to happen. And so really the point is here that we have got declining resources, increasing needs, and there's going to come to a situation where pretty soon the two are not going to be able to meet anymore. And really what ESG investing is trying to say is that we need to recognize the actions of our investments as institutional investors on the environment through the companies that we invest. And so what we should be doing is demanding that the companies become more cognizant of their own investment behavior, or at least of their own their business behavior effectively, and its impact on the environment. So carbon disclosure projects, for example, are the kind of initiatives which are being supported. And some of the managers I'm going to talk to now are designing products or designing investment portfolios that minimize the carbon emissions for their clients. Okay, yes, just going through this I've talked to already. Essentially revised Regulation 28 in the preamble says that it's your fiduciary duty to take ESG factors into account. And then the Code for Responsible Investing, first principle is an institutional investor should incorporate sustainability considerations, including ESG, into its investment analysis and investment activities as part of the delivery of superior risk-adjusted returns. So it's really just recognizing that we have this responsibility as investors to take this into account when we make our investment decisions. And really, I'm trying to say, well, what can we do right now in terms of providing an investment alternative? And apologies for the pretty small slides, but I'm just going to, no, I can't take this off. Okay. Essentially what we're proposing is a fund-of-funds solutions, which would be under the responsibility of Might and Optimal. We cover a range of asset classes in this. Currently, in terms of the specialized offerings, we really only have two asset classes, bonds and equities. Property and private equity are really interesting areas that we would like to invest in, but at this particular point in time, we weren't able to find ESG-focused investments are in the property space and in the private equity funds. Private equity is a bit of a challenge from a fund of funds perspective because of its minimum size and its lock-in periods. You're looking at 5 to 10 years for different funds, and you're looking at a minimum investment size of around 50 million rands. These are, obviously that varies by fund, but these are the kind of figures that I was able to find for ESG type funds. In the property space, we have identified one fund, which is the Futuregrowth Community Property Fund. Unfortunately, that's closed at this point in time. They're looking for new investment opportunities, and they said they will reopen it later on in the next 6 months or so. So that may well be a gap that we could fill in this space. But looking at bonds and equities, I've identified two managers that could play in the bond space. The first is the Futuregrowth Infrastructure and Development Bond Composite Fund. The second one is the Cadiz SRI Bond Fund, and that's something which I worked with directly, so I know it very well. That's a very interesting, both of these are very innovative in the sense that they're making unlisted debt type of investments. So they are making loans directly to companies which are not able to access either through the banking system or through the corporate bond market funds for their activities. And from a social perspective, they're having a very demonstrable, large impact on the lives of the people associated with their clients. So those are very exciting and probably the biggest impact in terms of society that we as investors could make. On the equity side, you're constrained to listed equities, and so really what we're finding and what I looked for and I found was different approaches to constructing equity portfolios with a focus on E, S, and G. We have the Emergence Low Carbon Equity Fund, which tries to replicate the SWIX, the shareholder weighted index, with a low carbon lens. So effectively it's trying to replicate equity market returns with a low carbon, as low as possible carbon footprint. So as not to sort of trade off returns for this particular goal. Environmental sustainability goal. We have Element, which is a well-known investment manager in the active corporate governance space, and they provide a lot of oversight in terms of managers and active proxy voting type of interactions with management. So really there again is another diversified equity portfolio with a particular focus on corporate governance. Three Laws Capital, this is a new investment manager focusing specifically on climate change, and it's a new fund that they're setting up, and I'm very keen to support them. And really what they're focusing there is on the resource efficiency of listed companies. And they measure this and they construct their portfolios around the most efficient, resource-efficient companies. And they also look at the ability of companies to respond to climate change. I think it's pretty well accepted that climate change is happening, whatever the reasons for it, but climate change is happening. Extreme weather is happening, as we saw in the video. And this is going to come at a cost to individual companies and ultimately societies. And so what they're focusing on is identifying the company's best position to deal with these extreme weather events and constructing portfolios to take advantage of that. As I said, in property and private equity, there is great potential for investments in infrastructure particularly, and having a social impact, and private equity through either shares in the kind of renewable energy that Wayne was talking about, or other type of social initiatives. You could have a very large impact on ESG type of targets. So private equity, I think, is potentially the greatest, most exciting area, but it's also the most difficult area for an institutional investor to to access. What Wayne was talking about earlier is exactly designed for this kind of solution. All we need is the mechanism by which we can access it as a fund of funds. So we need an asset manager that will construct a portfolio. So your Futuregrowth type of infrastructure development fund, I'm sure they would snap those up when they come onto the market, and we would be able to benefit from that through a holding in their fund. Or even better, if we could get a targeted renewable energy fund, that would be fantastic for us. That would be exactly what we'd be looking for. So I'm very excited to hear what Wayne's engaged in. It's going to feed more and more into this. Now, guys, I was quite amazed. There is nothing like this in the market, or nothing that I'm aware of, in terms of providing targeted access to an asset, a range of environmental, social, and corporate governance focused products. Because this, to me, is kind of like a no-brainer. The counter-argument to this type of solution is to say, well, actually, you're never going to ever put all of your portfolio into something like this. It's always going to be an add-on. Whereas, in fact, what you want is ESG-type principles or considerations to permeate across the entire investment universe. You don't want this to be a specialist niche-type product. So maybe, in a sense, this is a stopgap until ESG becomes the norm in terms of investment decision-making. That's a longer-term process, and it's going to take a while for investment managers to integrate ESG in a meaningful way into their study. So this is a pretty good solution for now, but I do hope that ultimately this will become irrelevant. Everybody will be an ESG type investor, and social impact will be just another way of distinguishing yourself from your competitors as an investment manager. But at the moment, there's nothing else, which is kind of weird. But it's a great business opportunity for me. So anyway, I'm very excited about this. And Steve, thank you for kind of kickstarting this particular process. Now, I've got a kind of review of individual managers, but I'm going to go through that quite quickly because this information is certainly available and I can share it all with you around it. But I just want to highlight a couple of things. I mean, Futuregrowth has had a sort of social conscience for a long, long time, and a lot of it permeates a lot of their products. In particular, from this sort of fund of funds perspective, we see them as being the infrastructure specialist. The infrastructure bond fund is really a targeted fund which we can invest in and have an ESG. It meets the ESG mandate because of its impact on the infrastructure development of South Africa. Okay, and you'll be able to see that by investing in the listed and unlisted space, they are able to, on average, pick up a yield enhancement of the all bond index of about 2%. Again, good investment opportunities. Obviously, this reflects credit risks. They need to manage that. But I've met with the team, and I'm very impressed with their ability to model and understand the underlying investments' credit risks. So this isn't risk-free, but this is a good investment opportunity for us as investors. It's an enhancement on your all bond index. And so you can see their target is, the benchmark is all bond index plus 1%, which is the grey bars down here. And you can see that they've been able to outperform that consistently for a long time. This is a really good investment, irrespective of whether it's an ESG fund or not. So for us, it's a no-brainer. The other bond fund is run by Cadiz, and this is something which I know very well, as I said. I was part of the team that was, I didn't develop it, but I certainly helped the refinement of it. And it's headed up by a lady called Heather Jackson. And she comes out of the fixed income environment. But this is effectively in the same, it's like a private equity bond fund, if that makes sense. It's making unlisted loans to companies directly. And it's able to charge prime type returns for these kind of loans. Now, the companies are wonderfully happy because they can't get access to money elsewhere. They're not the kind of businesses that Wayne and his team can support. You don't have big turbines producing electricity at guaranteed prices. That's a great asset from a bank's perspective. These are small microfinance companies. These are building property enhancing type companies, urban renewal type companies. They've even got a company, if I go into the next slide, that provides life insurance to AIDS patients. These are people who are previously uncovered, and yet by using technology to track people's antiretroviral use and linking the cover to that demonstrable use of antiretrovirals, they've dealt with the problem. So as long as people are taking the antiretrovirals, the mortality risk is relatively low. A very clever solution. They weren't able to raise funds with it. Cadiz was able to provide them with funds. So that's the kind of the spread of assets that they have: affordable housing, microfinance, and there's the healthcare, the 8.81%. So this is fantastically exciting opportunities for an investor, or environment, or socially, a particular social impact is what they track. And this is a great way to get into assets which you can't otherwise. And so I particularly like this a lot. They also do the social reporting. It's not particularly clear, but on the left there, they do annual reports, I think even on a quarterly basis, where they track the number of people that these investments have hit or have impacted on. So either they're the clients of the insurance company or the clients or the number of people that are renting accommodation through the housing companies or the people who received loans. And they can demonstrate the impact of this on the society, and they track that. So it's a really nice additional a sort of an output that you can pass on to your members to demonstrate your social impact. So this is a very nice solution to this ESG type fund of funds. Mergence, they have been focusing on ESG from an equity perspective for a long time. They put together the low carbon equity fund, which on the bottom right there you can see the returns from that fund relative to the SWIX. So they've been able to match the SWIX while reducing the carbon footprint of that particular investment solution. This, to me, it's less exciting than the bond stuff because its social impact is probably, its environmental impact is definitely positive, but it's probably less direct in the way that these were. It's less exciting, but at the same time, if you are investing in equities, this is a much better environmentally sustainable way of doing it. It's actively managed, Stephen. Yeah. But obviously, the tracking area is very tight, so there would definitely be the kind of exposures that they're taking is not that great. And so from an environmental perspective, you kind of wonder, is it really making that much of a difference? But still, it is an ESG-focused investment, and so it meets the mandate of this. Element, as I said, are very strong in corporate governance, and they've got a member of staff, David Coolidge, who I met while I was on the CRESA committee in terms of drafting the CRESA code, and he was very instrumental in terms of getting proxy voting and disclosure proxy voting part of the CRESA code. So making people take responsibility for the decisions they make in terms of approving underlying companies' management decision making. Here it's effectively a value type fund, and unfortunately its performance more recently has not been particularly good. But again, that's pretty true for a lot of value type funds. Sylvia, you probably excluded. But value funds have been taking a lot of strain recently because of the underperformance of resources and the outperformance of the retailers and other industrial shares. But still, it is an ESG focus. It's got the corporate governance element to it. The last one, as I mentioned, is Three Laws Capital, and really focusing on the impact of companies' behavior on the environment and vice versa, the impact of the environment on the company's behavior. And so they're creating portfolios around which to minimize the impact of extreme weather events. And so they've got a partner, an offshore partner called Osmosis, which measures the resource intensity of companies, and they've taken that technology and applying it in the South African context. They've licensed that. So they've got a systematic approach to this, proprietary approach, which is good. And while they're a new fund. It's an experienced asset management team. And so I'm very keen to back them to get this up and running. But as you'll see from my allocation, it's going to be relatively small to them to start with. Okay, what does the portfolio look like from an asset class perspective? Well, there we got the asset classes: cash, bonds, equities, property, commodities, alternative investments, and offshore investments. The desired strategic, the first of the red boxes, is kind of where I'd like to play. Cash I put at 0, which is not so good from an asset allocation perspective, but more from an ESG impact perspective. It's very hard to find ESG-specific cash funds. I mean, that just doesn't exist. So I've not allocated funds to that. The focus is around bonds and equities. The target, by the way, is CPI plus 3%, which is a pretty conservative target. This is meant to be sort of a middle-of-the-road type of solution, not an extremely high-return solution or a very, very particularly safe solution, again, because of the lack of the cash alternative. But potentially we could offer a CPI plus 5 given the performance of the funds that we're looking at including here. So if that is what the market wants and needs, we could certainly redo this by controlling or adding to the equity allocation there. Property, we'd like to get to 10%, and alternative investments, we'd like to get to 10%. Those are close to the regulatory limits. And but at this stage, the second red bar just shows the initial strategic. This is kind of what we can do right now. So if we had to pull the trigger tomorrow, that's the kind of allocation. It would be straightforward 50-50 bonds and equities. And there would be a range to play within because of our, as asset consultants, belief in the need for active asset allocation to manage risk. You don't want to be stuck in fixed asset allocations when you have really long-term extreme movements from the mean. That's very much reflecting our strategy. Okay, so how did a fund like this perform? I've taken just the generic equities and bond index returns. Our funds would be expected to outperform that, obviously net of fees. And so this is probably conservative given the historical performance. But what we can see is just on a compounded returns basis, which, by the way, is a really bad way of showing it. So I'm going to show it in a different way now. But on a purely compounded returns, we've done okay. But that's really being driven by your equity performance in this particular time period. Bonds have done well too, certainly above the CPI plus 3 target. If you look at the outperformance on a monthly basis, which is the green bars, on a rolling 1 year, which is the blue line, and on a rolling 3-year line, we can see that we've been able to consistently outperform CPI plus 72% of the time. So it's not a bad solution, and this is on a static asset allocation, and it's using index returns. So it's not directly reflective of the actual performance that we get, but it is indicative that this kind of asset allocation can work in terms of achieving a CPI plus 3 target. We'd have to be more aggressive if we wanted to go for CPI plus 5. Okay, what about the allocation to the funds? Well, you can see that I've gone 50-50 with the bonds and equities. And in terms of the bond funds, I've gone for a straight 50-50 split. You could get fancy and try and optimize it, but I haven't really bothered to, because to be honest, we're buying them for their exposure to particular strategies, not for the pattern of returns and the correlations of those returns within it. So you might want to, maybe we could do this a bit more scientifically, but I'm saying that each of these strategies effectively is equally important. On the equity side, I've given the highest allocation to Mergence because of their relatively good performance over this particular period. Element is struggling at the moment, and so I've underweighted them. And unless I can hear, and I still need to meet with them to understand exactly why they're underperforming that basis, so that allocation might go up over time. And the 3 loss capital, because it's an unknown at this point, even though they've got some good people in the team and they've got a good systematic process behind it, I've kept the allocation relatively low at 7.5%. So that's the kind of product which I'd like to be able to offer to clients, and it would be done through a pooled vehicle type of full product via Momentum Life License. Momentum is just one of many providers of a life license. Their systems in terms of the reporting and the oversight of the product is particularly good. Unfortunately, this solution means that it's not available to retail or individual investors. It's only available to institutional investors. But if the demand was there, ultimately we could create a unit trust based on this approach quite easily if the need was there. What would it cost? Well, this is the fee distribution. We've got the individual fund fees over here. And obviously these are scale. They're based on a scale of assets. So this was based on an estimated portfolio size of about 200 million. And so that's the kind of fees. And you can see there's a range of different fees. Cadiz in particular is quite expensive. That reflects their social impact type of reporting and research they need to do around that. Futuregrowth is significantly cheaper. They deal mainly in listed stuff, whereas the Cadiz stuff is unlisted, so there's a much higher credit assessment. Mergence, very cheap in terms of their product, and so that enhances the sort of quantitative stuff. Element and 3 loss capital come in slightly more expensive. You have a multi-manager fee. As much as I'd love to do this for free, I'd like to earn some money as well. That comes with your administration fee, gives you a total fee about 1.3%. This is more expensive than other balanced funds, but again, it's a function mainly of the underlying investments. If you wanted to, we could make it cheaper. We could cut out the active asset allocation, the multi-manager, and simply run it on a fixed allocation. That would reduce the fee. So again, if that's an issue, if that's a solution, you could certainly do that. I wouldn't be that happy, but you could do that. Okay, what do we need to do? Well, ultimately, it's just really around specifying the mandates between ourselves and any potential clients, and then we would then appoint the underlying managers. And in that mandate with ourselves, we would limit it to specialist ESG managers only, have the target of CPI plus 3%, and then confirm those asset allocation limits. Ultimately, we'd like to take this further. We'd like to get into renewable energy. We'd like to get into property. We'd like to get into private equity if that's possible, if it meets the needs of the clients. So that would then be covered, although the potential for that could be covered by the mandates. So anyway, this is a potential, certainly something we could do right now if we wanted to get exposure to ESG type products. ultimately, though, I think this is really just a step in the evolution of investment management and the expression of your fiduciary duty as trustees in terms of your members. We do need to have a sustainable, our impact on the environment must be sustainable, societies must be sustainable, and we're going to achieve that through good corporate governance. So these factors are, to me, fundamental to any kind of investment strategy. And while we only have a limited number of funds focusing explicitly on this, I think it will improve over time. And the range of assets that we can invest in will certainly improve, and that will help our performance and ultimately your members' performance. So I'm excited about this, and this is one version, and I'm very surprised nothing like this exists. So maybe I'll need to get going as quickly as possible and get the first move advantage. But you probably will find more and more of this coming into the market over time as people respond to these needs. So Steve, thank you very much. I appreciate the time.
Well, thanks, Evan. I think that you have shown us that it is quite possible to invest in this fashion and still attain reasonable returns or good returns. We wanted to put it out so that you guys can start thinking about it. We have a duty as consultants to advise you to make sure that you do take ESG and SRI into account. This is one potential solution. I'm sure that there are going to be many, many solutions over the years. Evan, thank you very much for flying up from Cape Town specifically for this, and I hope that you would accept that from us.
Thanks for the opportunity. Much appreciated. Thank you.
Guys, as I said, thank you very much for coming. I hope that you'll stay for a drink or two or three and some snacks. And we want to be doing these kind of sessions on a much, much more regular basis. I hope you enjoy the format. It's a little bit less stressful than a formal morning training session or whatever. So give us some feedback how you thought it went and what you feel we should be covering, and we would love to attend to that. So thank you very much.